Joining us now, once and for all. Joining us now to talk more about next week's Supreme Court case and the possible outcomes. Former Democratic U.S. Senator John Breaux. He's now a spokesman for Saving America's Family Enterprises. So, longtime Democrat doesn't want a wealth tax. See that? None of this is clear cut, I don't think. Senator and Daniel Bunn is the president and the CEO of the Tax Foundation. Are you guys on opposing? Have opposing opinions on this? Let me start with you, Dan. What should the Supreme Court do?
Thanks so much for having me. I think what's at stake here is very similar to what Paul Ryan described. I'm not in favor of a wealth tax, but you could blow up significant portions of the income tax if the Supreme Court rules too broadly on this issue, putting at stake billions, if not trillions, in U.S. tax revenue. And a lot of this boils down to the complexity of taxing income. And when you've got definitions in the tax code that attribute earnings to shareholders, attribute earnings to closely held business owners, you've got to be able to tax those earnings if you're working within an income tax. And I think this case could blow up a lot of those issues and create mountains of litigation if not decided more narrowly to forestall a wealth tax.
Senator, you obviously represent a lot of small business, and we've heard what would happen if there was a wealth tax or a tax on unrealized gains. I don't know. The consequences unintended of that would be significant. But do you understand what the other side is saying about how it would disrupt current tax law, or is it worth it to get the wealth tax off the table once and for all?
Well, Joe, our association, the SAFE Coalition, believes everybody should pay their fair share of taxes. But if we want to raise more revenues, there's a lot of ways we can do it that are constitutional. And one of them we would suggest is the tax cap. That's $680 billion a year in unpaid taxes on laws that are illegal and constitutional and already on the books. But the 16th Amendment was very clear, Joe. It said simply that the Congress can tax individuals on income that they derive. In the Moore case, they never got a dime. The company they invested in made a lot of money, but they kept the money in India. And the Moores never got a dime from their investments at that point. And the Ninth Circuit Court of Appeals said, well, we're going to tax it anyway. And you can't tax people's income on income that they haven't received. It's kind of a guess tax. We're going to guess what you owe, and we're going to tax you on it.
What do you think of that, Daniel? We heard maybe they did have a loan or some type of benefited in some way from the company. Is it more complex than what the senator just described?
It's both more complex and more simple. This is a pass-through entity. The Moores owned more than 10% in shares of that entity, and the U.S. tax code says that they should be attributed income from that entity. Now, prior to 2017, they were able to defer taxes on that income until it was repatriated. But as part of the 2017 Act, there was a discount rate applied to accumulated deferred earnings. And that was the rate that the Moores had to pay. And this is just the challenge of saying, well, it's income, it's offshore. Well, the Congress decided to include that income as part of the 2017 reform and to be able to go forward with a different system, different treatment of foreign earnings.
What about that, Senator?
Well, the law that they passed in 2017 in the Trump administration is unconstitutional in the sense that portion of it that says you can tax people on income that they've never received. Can you imagine people saying, I'm going to have to pay taxes on money that I never got? And the 16th Amendment was very clear. Following Supreme Court decisions also substantiated that you can only tax income that an individual receives. They got a loan from the company. They paid it back. They were reimbursed for travel expenses that they had already paid. They never got a dime in income, and you can't tax what you don't have, and they never got any money. And that's the principle of this case. If there are other laws on the books that fail to meet the constitutional requirements, well, they should be taken down. But in this case, this specific case, I think it's very clear that what the courts did, the lower courts, is unconstitutional, and I think will be declared so.
So, Dan, you're not for a wealth tax, obviously. Do you have a way or any changes in the tax code that gets out, that would get at some of that money that's never been touched, people that have, have never paid taxes on billions that they've accrued?
So I'm not in favor of a wealth tax. A wealth tax is economically harmful. There's all kinds of research that Tax Foundation has done on that issue. And I think when it comes to the deferred earnings, the U.S. tax system for a number of years allowed companies to defer taxation of their foreign earnings. And this created incentives for companies, not saying that the Moores did this, but a lot of companies to put their earnings offshore or keep those earnings offshore rather than bringing that home. And our 35% corporate tax rate encouraged that behavior as well. But the reform, and as part of the reform, you had to tax those earnings unless it was, otherwise you would be, essentially forgiving deferred tax for a lot of companies. And the reform provided a reduced rate to tax those deferred earnings. I think a lot of this boils down to the income tax. I'm in favor of moving the tax code to a consumption tax rather than relying on the complexities of an income tax. But these were earnings that there was taxation deferred that Congress then said, no, the tax is now due at a reduced rate.